Welcome to IGTV. I am Angeline Ong, and we are looking out for the breaking news set piece of the week, the non-farm payrolls that are due out any minute now. Let's just get you across what the expectation is. And we are looking out for 185,000 jobs created in January after 223,000 in December. The unemployment rate that the market is looking out for is for it to rise to 3.6%, nudging up slightly from December. And the average hourly earnings 0.3% month on month, 4.3% year on year. But there's been a lot of talk about how this number could veer strongly all week. Here to talk to us about that right now is Josh Mahoney.
Yeah, I think this is going to be an interesting one, and a week that has been dominated by central banks. Certainly, it feels like no one's really listening to the central banks because despite warnings that they could raise interest rates once again, unlikely that people really care because people are focusing a lot on what's happening in terms of the longer term outlook. The economic picture is going to come in focus today, though, because as long as we are in a position where we're not necessarily seeing a massive collapse in terms of the jobs market in the US, then there's less pressure for them to act in terms of easing rates down the line. The big market, I think, today is going to be the US dollar, but I'm going to start off with stock markets. The NASDAQ has been a leader within this recent charge higher, and that's because of the fact that, by and large, tech stocks have been hit hard, and we're starting to see them bounce back in a meaningful manner. Here's the weekly time frame for the NASDAQ, crucially coming up into the 76.4 Fibonacci resistance level at 129.46. That comes off the back of the breakthrough 122.58. So do we respect that level and continue this wider downtrend? Remember, this latest double bottom came without breaking the 104.32. So that points towards the possibility that this could be a retracement. So what we do at 129.46 is going to be absolutely crucial here. So let's just drill in here. We're continuing to really play along the lines of the uptrend that's been dominating January so far. So as things stand, you can see that weakness that we saw coming into play yesterday looks like it's just being bought into once again. Are we going to continue that push and push up through the 76.4 fib, or will we start to reverse from here? That's one place that we're going to be looking at. Like I said, I think the US dollar is going to be the key one to be looking out for here, just because of the implications it has across the board. If you're looking at commodities markets, FX markets, everything's really dominated by the US dollar. And what we have got here is, of course, a protracted move towards the downside. By and large, this is a risk on move. As we see equity markets moving higher, we're seeing weakness in terms of the US dollar. If we start to see this pop, that by and large would be indicative of people looking to sell equity markets and looking to get back into some of these haven aspects such as the US dollar, such as dollar yen, which is rolling over. And in actual fact, arguably, you could say that the yen is the better haven out of the two at the moment, because when the US dollar is strengthening, we're seeing the yen strengthen even more as we see that sort of tightening in terms of the inflation numbers between the US and Japan. Nonetheless, that 4-hour chart shows you exactly why this is interesting. 61.8 fib retracement, 76.4 fib retracement. The latest rally took us into that 61.8. Bearish engulfing candlestick formation now complete. This points towards a continuation of the bearish trend with a move lower from here. So certainly look out for today's numbers and what they can do for the US dollar. Unless we break that 102.26 mark, I think there's a good chance that we do continue on this vein and move towards the downside. Certainly the caveat here is, how are people going to look at, say, the likes of unemployment and the non-farm payrolls? If we see strong numbers, then you could say, well, this means that it's good for the economy. This means that it's going to be a soft landing. We're not necessarily going to see a huge deterioration in terms of earnings. So that's positive. That's risk on. The flip side of it is people could look at it and say, this is less pressure on the Federal Reserve to start sort of unwinding this move that they're seeing in terms of tightening monetary policy. So it's going to be very interesting to see how they look at it. And that sort of dual-sided nature of it means that we could see plenty of volatility once these numbers are released. The one area you really want to focus on here is average hourly earnings, because that's the clear one. If we see a significant pickup in terms of earnings and wages, that's a risk-off move, because that could mean a resurgence in terms of inflation. And talking of the US dollar and the impact on other markets, gold is another market that we should be looking out for. The daily time frame pointing towards the potential for a bearish turnaround, given that engulfing pattern we saw yesterday. But so far we haven't broken out of that sharp reversal that we've seen. We're now starting to move sharply lower. So you can see as the numbers are being released, we're seeing the likes of gold heading lower, and presumably, there we go, US dollar heading higher.
Wonderful. And just the right timing, Josh, because we're just getting those numbers breaking right now as we speak. Non-farm, a really strong number there. Actual increase of 517,000. That's way more than the 185,000 that the market was expecting. The unemployment rate, 3.4%, slightly less than the 3.6% that was expected. And we have the average earnings month on month bang on at 0.3%, matching expectations. The year-on-year figure, 4.4%, slightly higher than the 4.3% that was expected. I can tell you that gold is nudging slightly lower thereafter those results. Back to you for the charts. How are the trades going? Look at the dollar go there, Josh.
Yeah, I mean, this is an incredible number that we've seen here. Completely caught everyone off guard. If you look at the sort of major estimates that we'd been seeing out there, even the most optimistics were just looking in the sort of mid 200,000. So it's going to be interesting. Obviously, we're not looking at it right now, but really drilling down into exactly why we've seen this huge disparity in terms of the ADP figure that we've seen, and now seeing this massive outperformance in terms of the jobs number. At the moment, we're seeing a significant move higher. So this is a real boost as things are seeing it for the US economy. Like I said, you can see it in two different ways. People taking this as a positive and maybe thinking that the earnings destruction that everyone had been looking for isn't necessarily going to happen. So we're seeing a big move higher in terms of the US dollar. Let's just take a look at some of these. Thinking about what I was saying, in actual fact, US dollar strength, of course, that's a risk-off move. So we're seeing the US dollar strengthening as people are now starting to move in against some of the equity markets, the likes of the Dow rolling over. And then, like we were talking about in terms of the NASDAQ, if we look at, say, the weekly time frame, remember that 76.4 Fibonacci level, well, we're starting to build on that and starting to turn lower. So I guess the caveat here, or the outlook here, is that if we're seeing outstanding jobs numbers, there's really nothing to stop the Federal Reserve from continuing to push interest rates higher, because they view this as essentially a very soft landing, and they're not necessarily seeing anything to stop them in their sort of determination to drive inflation lower by implementing higher interest rates. So at the moment, it seems to be some real desire to get short equity markets, long the US dollar. It's a risk-off move and the potential for some weakness going forward.
Really interesting facts there, Josh, and thank you so much for sharing your charts. The dollar, at least the dollar index, they're shooting high after a very strong reading on the US labor market, showing that it is very resilient, as the data has shown at the moment. Potentially, this will give the Fed further ammunition to continue in its rate tightening. And that's the latest from IGTV. I'm Angeline One.